Good evening, friends. Welcome everyone for today's session on profit split method. So, this being chapter B3 in our UNTP manual. Last time we saw B2. So, now we'll be focusing on chapter B3, which is on profit split method, as to how this method needs to be applied, where this method would be relevant, where and all it won't be. So, some insights about this method. Before that, would like to acknowledge the efforts of Sundararajan for preparing this presentation. The legends used, we have seen it, friends, more or less similar to our earlier presentations. The schema for the evening, it would be introduction, strengths and weaknesses of the PSM method, profit split method, appropriateness, indicators of PSM, approaches, measures of profit, and profit splitting factors. PFM, one of the methods of transfer used in determining computation of arm's length price. Useful, but again a complex method of determining prices. So it's again, friends, it's not a go-to method when it comes to transfer pricing. So its relevance is only for specific transactions or for specific circumstances. This method can be used. It's not like transaction net margin method or cost plus method or cup for that matter, wherein like we can use it frequently. So again, even though useful, but again a complex method, starts by identifying relevant profits or indeed losses in relation to the control transaction. So as the name suggests, profit split method, wherein the profit is splitted. How it is splitted, amongst whom all it is splitted, what is the basis for split, that we will see in subsequent slides. Strengths and weaknesses of PSM. It can provide a solution in cases where one-sided methods. So what is the meaning of one-sided method? When one party to the control transaction performs benchmark function. So say for example, cost plus method, resale price method, TNMM method, these are one-sided methods wherein like one party to the controller would be considered the tested party and benchmarking would be done basis that party. Where these one-sided methods are not appropriate or not relevant, that's where PSM comes into picture as a two-sided method where both the parties to the control transactions are tested. Here both the parties and even along with these two parties, the entire group as well, there may be instances that even entire group may be used or kept as a base for determining the basis for profits or for allocating profits. It is able to deal with returns to synergies between contributions of profit arising from the economic scale. So for entire group is considered, in the entire group, all the components of group, be it all the related associated enterprises, what are the functions performed by each of the related parties for that transaction. So all the group is considered, or the entire group is considered as one entity, and all the individual components are considered as individual transactions, and whatever is the contribution for each entity towards their functions, that is measured under PSM. What is the weakness is often complex, as I said, because basis of allocation is always subjective. So one may say for say if at all there is software development transactions and research and development needs, or research needs to be done for that software development. The research entity might say that okay, for us the cost is this much, and you add this much markup on our cost and give us this much amount of profit. So there is no relevant basis for allocating profits or for allocating costs, or for allocating the margins which is earned in that particular transaction. So that way it becomes very difficult for PSM to apply. Second, determining an appropriate way to split the profits can at times be challenging. Yes. Again, thirdly, it is highly reliant on the detailed data from the M&E group. As I said, friends, the M&E group needs to provide few data or provide few indicators from their end as well to the Indian entity to just to in a position to justify the transaction. If those data are not available, PSM method may not have its relevance. So where is the appropriateness? Where exactly PSM is used? PSM is used where there are commercial and financial transactions wherein like those are integrated transactions. So the usage of PNM would be like integrated. So it is not a sole transaction which can be benchmarked separately, where there are transactions which are dependent on another transactions. If there is so much integration, and also there is uh, uh, complex transactions like say which are involving intangibles, which are involving royalties, this is where the usage of PSM would be high. On the contrary, where the transactions are very simple, similar, where cup or it can be justified with cup or CPM or TNMM, there the PSM may not have its relevance. Primarily, this system determination is based on the nature of accurately delineated transaction in the context of circumstance. What is the accurately delineated transaction, friends? It is about assessing how the actual behavior of the parties to the transaction stacks up against what is provided in the written context. It focuses on pricing the real deal as opposed to pricing a written contract that may not reflect the true contribution of the parties to value creation. Indicators of PSM. The profit split method may be appropriate where each related party to the transaction makes unique and valuable contributions. So, friends, again, contribution should be unique and valuable. It cannot be an ancillary or it cannot be a supportive function being done by a particular entity. The contribution from that particular entity has to be number one unique. Second, it has to be valuable, and or the business operations of the little party are so highly integrated, as I said, friends, that they cannot be reliably evaluated in isolation. So the business operations needs to be integrated. So one activity's output can would be we can say an input for another entity or for another activity, and likewise the entire series of transactions are placed. Third, parties share the assumption of economic significantly risk or separately assume closely related risk. So there is sharing of risk. If this is what is the scenario, then yes, PSM can find its relevance. Where none of the indicators are present, as I said, friends, the integration, as I said, the transactions are highly integrated. Second, every entity makes unique and valuable contributions, and thirdly, there is sharing of risks. If none of them are present, then PSM may not find its relevant, friends. It is likely to be more reliable to apply transferring when making use of the uncontrolled comparables, even in cases where perfect or closely comparable uncontrolled transactions are lacking. So if these three parameters are not there, it is better to use the transfer pricing method apart from PSM. We can use CUP, CPM, TNMM, and if not, resort to any other method as well, because that is also an option available in Indian context, Indian transfer pricing context. We can resort to that, but do not go for applying PSM. Unique and valuable contribution. So what is, as I said, friends, it cannot be an ancillary function provided by done by or a supporting function. So every entity has to provide or has to give its 100% in terms of contribution to that particular series of transactions, and it's there has to be a cost associated to those functions. Again, there has to be a markup associated to those functions. It has to be key functions. It cannot be a function wherein those are supportive and no cost can be allocated to those functions. Second, highly integrated operations. PSM is likely to be most appropriated only in those cases the integration is so significant that the way in which each party performs functions, uses assets, and assumes risks is interlinked with and cannot be reliably evaluated in isolation. Example of highly integrated which may warrant the determination where the related parties perform functions jointly, use common assets, and share the assumption of economically significant risk. So if that being the case, PSM can be used. Another example of a highly integrated operation between the takes the form of high degree of interdependency. As I said, friends, an output of one entity may be an input for another. sorry, friends. Shared risk, further indicated that PSM may be the most appropriate method is where the parties to control transactions share the assumption of economically significant risk in relation to a transaction. So there is sharing of risk. So there are, say, five parties to a transaction. All the five are sharing risk for that particular transaction. That being the case, PSM's usability or usage can be more. Availability of information. It will often be the case where PSM is found to be most appropriate. Direct comparable transactions that may otherwise be used to prices will not be found. However, information from uncontrolled transaction may still be relevant to the application of PSM. For example, in terms of how the relevant profit should be split amongst the parties. As I said, friends, once we have confirmed that PSM method would be used to justify a particular transaction, in such a scenario, availability of information would be paramount. We need to have information as to, say, as I gave an example, five entities are performing some functions, assuming some risk, employing some assets for a particular transaction. We need to have details of all five enterprises. What are the functions they are performing, what are the assets they are, what are the risks they are sharing, also what are the costs involved for doing that functions, what are the costs involved in employing that assets, whether against those costs what would be the reliable profit which can be appropriated. There has to be some comparable information. I'm not saying comparable for using cup method, but comparable information. There has to be a benchmark set. There has to be some history, or say some instances where these kind of functions have been performed. What is the markup being added? So those informations become relevant or are useful, or I would say are paramount to apply PSM. Now, after we get those PSM, how to apply PSM? There are three approaches, friends. This is important, friends. Contribution analysis approach, residual analysis approach, and comparable profit split approach. So, what is contribution analysis approach, friends? Here in this, what happens in the entire gamut of transactions? Say there are five entities. Five entities would benchmark their functions separately. So, pertaining to their function, what is the contribution done by them for that particular transaction, and they will benchmark their transaction separately. So each entity would be considered as a separate transaction, or function performed by each entity would be considered as a separate transaction, and it would be benchmarked. So this is what is the contribution analysis, which is not what to say frequently used when PSM is used. The one approach which is used frequently is the residual analysis. So what happens in this residual analysis? Step one, the routine functions. So, say for example, for a particular transaction, whatever routine functions are being done, for that there is a arm's length profit. So, say for we'll see in the form of an example as well, how to allocate profit for that routine functions. After that allocation have been done for routine functions, the balance which is left after allocating profit for routine functions, the balance residual profit on an economically valid basis. So again here, not in entities are not seen in isolation. Again, their functions are also not seen in isolation. Whatever is the residual profit, for that profit now there are five entities. So who those five entities has done what transactions or what functions, what are the assets employed, what are the costs involved, against that on an economically valid basis. So now PSM method, or there are OECD or UN would not say basis as to how it has to be, but yes, there has to be some logic, some rational, as I said, we need to see history. In case such transactions are done before by other, we need to see that and then allocate profit basis those allocation, or basis those uh, allocation which we have done. Illustration: XYZ Inc. develops, manufactures, and markets a line of products for use by the police in country A. Second, developed a bulletproof material for use in protective clothing and headgear, that is Stellon, obtains patent protection for the chemical formula for Stellon. Now, XYZ Asia, which is a subsidiary of XYZ Inc., manufactures and markets XYZ products in Asia, obtains license to manufacture and market Stellon in Asia, Its research unit alters Stellon to adapt to it military specification and develops a high intensity marketing campaign. So these are the functions performed by XYZ Asia. For the year one tax year, Y1 tax year, XYZ has no direct expense associated with the license of Stellon to XYZ Asia. No expenses incurred relating to marketing of Stellon in Asia. Some relevant figures: Stellon sales is around $500 million USD. Pre-royalty expenses. Why pre-royalty? Because XYZ would pay royalty to XYZ Inc. for usage of the product developed by XYZ Inc. Pre-royalty expenses are 300 million. Net pre-royalty profit is 200 million. Operating assets employed in Stellon business 200 million. So now these are the facts. Now how the allocation for routine profit and then the residual profit will happen. Step one: removing routine profit based on arm's length return. Based on an examination of a sample of Asian companies performing functions similar to the routine functions of XYZ Asia, it is determined that arm's length return on routine functions or operating assets in the Stellon business is 10%. So 10% on operating assets in Stellon business is the routine profit, which is on an arm's length basis for XYZ Asia. So that being the case, 20 million is the profit, or I would say routine profit, which needs to be removed for us to allocate the residual profit. So out of, so we had a 500 million USD as sales. Pre-royalty, what is the profit? So 200 million USD. Out of that, 20 million is the routine profit. Now we are left with 180 million dollars of residual profit. Splitting of residual profit, there comes the step two. Splitting of residual profit based on unique and valuable contribution. Residual profit of 180 million is attributable to the unique and valuable intangibles related to Stellon. To estimate the relative value of these intangibles, the ratio of the capitalized value of expenditure as of Y1 on Stellon related research and development and marketing over the Y1 sales related to such expenditures are compared. So these are the functions being performed by XYZ Asia, R&D and marketing. So that vis-a-vis sales, XYZ's capitalized R&D expenditure have a value of zero point 0.2 per dollar of global protective product sales. XYZ Asia's capitalized R&D expenditures have a value of zero point 0.4 per dollar of XYZ Asia Stellon sales. So these are the additional information given. Accordingly, it is determined that an arm's length split of the residual profit would see one third of those profits being allocated to XYZ Asia, that is 60 million, two-thirds being XYZ Inc. 60 million and two-thirds being allocated to XYZ Asia. So now how this one third and two-third was arrived, one third being the XYZ Inc.'s capitalized R&D. So out of zero point 0.6, so per dollar, XYZ Inc. is spending zero point 0.2 dollar towards R&D. Against that, per dollar, zero point 0.4 dollars have been expensed by XYZ Asia again for R&D. So out of zero point 0.6, zero point 0.2, that is one third, is being incurred by XYZ Inc. and major part has been taken care by XYZ Asia. So that being the scenario, 180 is the residual profit. One third would be allocated to XYZ Inc. That is $60 million, and 120 million would be allocated to XYZ Asia. That is $120 million. Hope this friends, this example was clear. Contribution versus residual approach. So what are the difference and how the residual approach will have upper hand over contribution approach? Firstly, residual breaks up a complicated transfer pricing problem into two manageable steps, that is routine profit and residual profit. Secondly, potential conflict with the tax authority is reduced by using the two-step residual, since it reduces the amount of profit that is to split in the potentially more controversial second step. See, if this allocation of routine profit was not there, then it would have been difficult to bifurcate entire 200. Now when routine functions, or say contribution, or I would say compensation for routine functions are being done, that way we are left with only integrated profit, which is pertaining to integrated transactions, which for which getting basis is very simple. That way, as we have seen, friends, out of 200, when we removed 20, basis to allocate 120 was very simple, because we had a ratio of expenditure incurred by both the companies, XYZ Inc. as well as XYZ Asia. So that way it was possible to allocate the residual profit. Comparable profit split method. So this is again not used very frequently, I would say not used in practical scenarios, because this talks about comparable profit split method. So we are using profit split method, but same kind of arrangement, if there is for our comparable companies, we need to use that, which is very difficult to find. So say you and your associated enterprise would be using some core functions, some integrated operations would be done. Now, to have a similar kind of setup for comparable companies would become very difficult, or would be next to impossible. So that's why this method will not, or this approach in PSM will not be relevant. Determining the profits to be split. The relevant profit to be split under pays are those which arise to the as a result of control transactions under examination. Level of aggregation of transactions in this regard would be important. So we need to confirm where we can consolidate all operations, where we can carve out those operations as a routine function. So this is very paramount, friends. What operations require profit split? What operations require a regular uh, routine allocation of profit for that for particular functions. So this becomes paramount, friends. If this is not being done, as I said, splitting entire 200 million in our example would have been difficult. But now when 20 million was already allocated, splitting 180 million was easy. Measures of profit and profit splitting factors. PSM is most commonly used to split net or operating profits. Applying the method in this way means that all the relative are exposed to both the income and expense associated with the relevant transactions in a consistent manner. Other measures of profit may be appropriate. For example, if gross profits are split, such related party would then deduct its own operating expenditure. So there are two approaches again. One may say, okay, splitting the net profit or net operating profit. Some may say, okay, let us split the profit at gross level, because say there are three countries involved, or three enterprises in three countries: India, US, and UK. The considering the geography, every entity will have its own set of operating expenditure, or their own admin and other marketing and sales functions. Everything would be there. So let us not uh, have that to affect our profit. Let us split it up at the gross profit level, and then once that split up is done, let everyone reduce their own set of operating expenditure and arrive at their net profitability. So this approach also is correct or logically fine. Actual or anticipated profits. So again, whether we need to consider the actual or the forecasted profit. PSM is most commonly applied to split the actual relevant profits. Since actual relevant profits would reflect the risk which affect the transaction, split of such profits will typically result in each party being a subject to those risks. Split of actual profit would thus be appropriate where the accurate delineation of transaction shows that each party shares such risk. So against, I mean, actual profit vis-a-vis anticipated profits, it's better to use actual profits rather than anticipated profits. The measure of relevant part to be split should be aligned with the accurate delineation. So whoever have performed what functions, the profit should be allocated basis that, and it cannot be a haywire allocation. There has to be some logic, some rationale in splitting the profits. Profit splitting factors. What are the various factors? PSM aims to determine transferring by reference to the manner in which independent parties would have divided profit amongst themselves had they engaged in comparable transaction. However, information on comparable profit splits or similar arrangements are often not available, so the method is more often applied by reference to some other measure of relative contributions to those profits of each associated enterprise as a way of approximating the outcome that would have been achieved between independent parties. So, friends, subjectivity would be there while applying PSM. So that, so that's why its usage becomes very difficult, or it is not commonly used, and other methods, that is CPM, CUP, as well as uh, TNMM, have upper hand over PSM only where, like, in integrated transactions, or where transactions are relating to intangibles, wherein like other methods cannot be specifically used, and even there is no leeway or cushion for any other method. Then in such a scenario, profit split method needs to be used. Again, the same thing, friends. Profit splitting. How to split the profit? What is the basis should be there, or how routine profits or normal profits should be carved out from the total profit, and then allocate the residual profit, wherein all the entities have contributed. This becomes, as it is a very subjective method of transfer pricing. The basis of allocation also would be subjective, but at the assessment level, I would say, friends, PSM, if at all it has been used, there has to be a lot more logic and rational in terms of split, how you are splitted, because you may say 20% for India and 80% for US. The Indian tax authorities would say, why 20? I would say 30, and you give 70 to US. At the time of assessment, it would be difficult to justify a transaction, or it would be a bit cumbersome to justify a transaction if PSM is used. So, at the time of doing transfer pricing study itself, if a care has been taken in terms of how the split up has happened, then it would be slightly easier to compare the transaction, or to justify our stand at the time of assessment. So these were some of our thoughts, friends, on the profit split method. Any questions would be happy to answer, friends. Thank you, friends.